Hello students, today we are going to start our new chapter, that is Financial Market Business Studies class 12th. In this chapter we are going to discuss about the financial market, what are the financial market, types of financial markets, functions of financial market, primary and secondary market, methods of new issue and stock exchange SEBI. Okay, so first of all, what is financial market? As you know, every firm needs fund and they can take fund from two sources, that is owner's fund and borrowed fund. These funds are mobilized through financial market. As you know, the savers, that is household sector, save their money in bank and invest their money in financial market. And these two sectors help firms to avail loan or finance. Okay, so financial market is quite important for availing good source of fund. So financial market act as a link between savers and investors. Financial market is a market for creation and exchange of financial assets like equity share, debentures, bonds, treasury bills, commercial paper, etc. So basically financial market can be said as a link pin between investors and savers. Okay, so this is financial system. As you know, the business firm need fund and household are basic a saver. They save their money in banks, or they invest their money in financial market in shares, debentures, bonds, treasury bills, etc. So the major link pin between savers and business firm is financial market. Okay, so there are two types of financial market. First of all, money market, and second is capital market. Okay, the process by which allocation of fund is done is called financial intermediation. As you know, the funds are allocated through the medium. You can see here this figure is showing that medium. The allocation of fund can be done either by bank or financial market as shown in the figure. Household can deposit their surplus fund in banks. Basically जो households होते हैं वो अपना पैसा बैंक में सेव करते हैं. The household save their money in banks in different form of deposits, saving deposit, current account, fixed deposit, etc. And these funds are used by bank for credit creation. Okay, what is credit creation? Suppose if bank have initial fresh deposit of 1000 rupees, they keep some LRR, legal reserve ratio, that is suppose 20%. Okay, so 20% of their initial fresh deposit, that is 200, keep as a reserve and remaining 800 invested as a loan or in other financial assets. Okay, whatever money they provide as a loan, they provide in a account open in same bank. If you avail a loan from PNB, they open another account for providing that fund. So again they get initial fresh deposit, that is 800, and again they keep 20% of 800, that is 160, and remaining 640 provided as a loan. So this procedure continued till the initial fresh deposit becomes zero, and by investing multiple times they create credit and get profit. So whatever money savers deposits in bank invest it as a loan. They provide loan to business firms and any other person who need funds. Okay. So basically, the bank and financial market both are important in mobilization of savings. So functions of financial market are mobilization of saving for channelizing into productive channels. Basically, whatever money we save are needed to be invested for making profit, but every person do not want to invest their money because it is very risky. So they save it in bank, and bank channelize that saving to that person who need money, who wants to invest in productive use. Okay, so financial market mobilize the saving of the people and channelize them in most productive use. Okay. Second is facilitating the price discovery, pricing of financial instrument. The financial market include both supplier and investor of fund. Okay, as you know, the price is determined where the supply and demand both are equal. So the demand and supply of fund determine the price of various financial instruments. Like price of shares is decided whether its demand is high. If their demand is high, then price will be high. If their demand is low, the price will be low. So it is very important for pricing of financial instrument, and financial market help for this purpose. Providing liquidity to financial assets. The financial market provide ready market for the sales and purchase of financial assets. The investor can invest their saving in long-term investment which could be easily sold in market whether desired. Thus, an efficient financial market provide liquidity to financial asset. Okay, you can easily sell your financial asset in financial market and get liquidity for it. Reducing the transaction cost. Okay, it is a common platform where the buyer and seller enter into transaction. So a person is not required to find the buyer or seller. It will save your time and cost, and he can simply buy or sell their security through brokers. You don't have to worry. Broker who charge a nominal commission for their services help you out for selling or purchasing security. Thus, financial market facilitate transaction and in financial asset as a very low cost. The sum up, the financial market plays an important role in allocation of resources and performing every important function for investment. Okay. So, what is money market? Money market is a market of short-term fund. Please underline this line, short-term fund. Money market is a market for short-term fund from which you can avail short-term fund and deal in monetary asset for short time period, the maturity period up to 1 year. Okay, there are so many money markets here mentioned: London money market, New York, Bombay, etc. Money market is a market through which short-term funds or debt instruments are sold and purchased. So it is a basic difference between money market and capital market, that is money market deals in short-term funds. Okay. So if you need money for temporary time period, you can avail them from money market. Okay. Remember this, money market deals in short-term funds. Okay. Now, instruments of money market. First of all, first foremost instrument is T-bill. Treasury bills, which are issued by, please underline this, which are issued by Reserve Bank of India on the behalf of central government to meet short-term financial need. Okay, it is also called, what it is called? It is also called zero coupon bond, zero coupon bonds. Okay, the maturity period of T-bill is less than 1 year. It may be 14 days, 91 days, 182 days or 364 days. These are important characteristics of Treasury bill which are underlined here, and in this box you can easily see many types of instruments along with the time period. Here I mentioned it. Okay, so it is a very good negotiable instrument and freely negotiable. They are highly liquid in nature. Okay, easily you can sell them, and Reserve Bank of India is ever ready, because Reserve Bank of India is ever ready to purchase it on discount. Okay. Okay, Treasury bill are available from minimum amount 25,000 and they issued at discount. What does it mean? If you purchase 1 lakh rupees, zero coupon bond, you only have to pay 90,000 or more, and you can easily purchase Treasury bill amounting 1 lakh. After some time, when you resell them to RBI, RBI will pay full amount, par amount, that is 1 lakh. So you get benefit of 10,000. Okay. This is called zero coupon bond, and it is sell and purchased through RBI, and it is sell on discount and purchased on par value. Okay. So here is short characteristics are mentioned. You can easily use them as a notes. Okay. Now CP, what is commercial paper? Commercial paper is short-term promissory note which is issued by the reputed company to meet its working capital requirement. As you know, working capital is short-term fund at a lower rate of interest than in market rate. Okay. The maturity of such paper may vary. Time period is 3 months to 12 months, and these instruments are generally purchased by commercial bank. CPs are purchased by commercial bank and issued through a company. Okay, a reputed company, insurance company and unit trust. Commercial paper are not backed by any security. You don't need to put any security because it is issued by the credit worthiness of company. The issuance of commercial paper is alternative to bank borrowing for big companies that are considered financially strong. So it is a temporary funds which are needed by the company, and they issue the CP on the basis of their credit worthy. Okay. So it is also called bridge financing, right? Okay. So commercial paper is a negotiable instrument and sold at discount and redeemed at par as a treasury bill. And time period, as you know, usually maturity period vary from 15 days to 1 year. Okay, and issued for short term requirements, right? Now call money or loans. Call money is a short term finance which is repayable on demand. Whenever the creditor demand money, you have to pay them. The maturity period of this is 1 day to 15 days, used for interbank transaction. Basically, call money is needed by the bank for the temporary period, because sometime bank face the shortage of fund, so they need some fund immediately, and it is called call money. The borrower of call money are commercial bank face the temporary shortage of cash, as I told you. Okay, it is conducted over phone. It is conducted over phone, and official work is completed afterwards. You can call them and take call money, and after that you can complete official papers or official works. Okay, it is a good source of money for temporary period. Okay, and it is based on CRR, cash reserve ratio, which is imposed by RBI. Okay, interest rate paid on call money is known as call rate. Okay, and it is very good source for day-to-day expenses, even from hour to hour. It is very temporary loan which is needed immediately by bank. Okay, now certificates of deposit. The certificate of deposit is a short-term negotiable instrument issued by the commercial bank or development financial institutions. Okay, it is a certificate, as mentioned here. It is also a short-term negotiable instrument. Its time period may be vary from 3 months to 12 months, and it is also a transferable. Okay, so certificate of deposit is also for 3 to 12 months, and it is also a negotiable instrument, and it is also a good source for banks. Okay, certificate of deposit are different from fixed deposit receipts. Okay, CDs, certificate of deposit, are negotiable instrument. It can be transferred to anyone. Okay, and जो FDRs, fixed deposit receipts, are not negotiable instruments. And the time period, very important, you have to remember this, time period vary from 91 to 1 year. Okay, and FDs is for minimum 7 days. Okay, there is no upper time limit for FDRs. Okay, CDs are issued on discount. Okay, and FDRs are issued for actual amount of deposit, and they carry special or specified rate of interest. Right? So, basic difference between certificate of deposit and fixed deposit receipt are these. Now, commercial or trade bill. Commercial bill or trade bill. So, commercial bill is a bill of exchange. You have studied this in class 11, used to finance the working capital requirement of business firm. Okay, it is a bill of exchange which is used for completing the requirement, the shortage of working capital. Right? It is a short-term negotiable and self-liquidating instrument used to finance the credit sales of firm. Clearly mentioned, it is used for credit sales. Okay, and a business firm selling goods on credit to another business firm will draw a trade bill on letter payable after a period of not more than 90 days. So, it is issued for maximum for 90 days. Okay, it is also transferable, negotiable instrument, and it could be issued on discount. It is depend upon the company. And a commercial bank bill is a negotiable instrument which is freely transferable or can be endorsed and issued for short time period, commonly used for credit purchase and sales of raw material, and can be discounted before the time period. As you know about the bill receivable, all the characteristics are mentioned here. Okay, so these are the instruments of money market. Now this is homework for you. You can solve this case study now because you study about the money market, and it is quite easy. You can easily find the answer. Ganesh Steel Limited is a large and credit-worthy company manufacturing steel for India market. It's now want to cater the Asian markets and decide to invest in new high-tech plants and machinery. Since the investment is large, it is required long-term finance. The management of the company decided to raise fund by issuing equity share. The issue of equity share involve high or huge floating cost. Okay? To meet the expenses of floating costs, the management decide to tap the money market. Okay? So, name and explain the money market instrument the company can use for the above. All the money market instrument you have to mention here, and what is the duration for which the company can get fund through this instrument, and state the purpose of which these instrument can be used by the company. Okay, so this is homework for you. If you don't understand the answer is quite easy. You have to explain money market and their instrument. Please ask me, or if you understand this case study, you should solve this in your notebook. Okay, it is used for practical examinations, and it is also help you for preparing your case study, thinking, your ability to understand case study. Okay, so here a video ends. In next video we discuss capital market, SEBI and stock exchange market.